Hello, in this lecture we're going to troubleshoot some problems that could happen with the master budget. Now, of course, this is a long process, and if we get to the end of the budgeting process, being the balance sheet, and it's out of balance, that could happen, and the question is, how do we go through there and find out what is wrong? And one way we could do this is we could actually try to basically journalize and record the transactions, and thereby recording the debits and credits as we go, and that could help us to see where we could be out of balance. So, in order to do that, if we wanted to take that approach, we could set up basically a trial balance based on what we have here. So in this problem, we're given a balance sheet here. We can journalize from the balance sheet and try to journalize this activity to get to the ending number. So let me try to just give an introduction to what that might look like. So if I'm just going to hide some cells over here, I'm going to right click and hide these cells so that I can have this trial balance. And I'm not going to re-input the numbers, but basically you're just going to take the balance sheet and you're going to put it into trial balance format, and that means removing the subtotals and I'm going to put credits as negatives so that it'll balance in that way. So for example, I'm just going to go straight down through here. Cash is going to be 40,000, accounts receivable 342, 248, raw materials 98.5, and then finished goods inventory 325,540. And then if I want to check my subtotals, it adds up to 108,288, 108,288. So we're on track. Then we're going to go to the equipment, 600,000, less accumulated depreciation. That's a credit of a negative. I'm going to put it in as a negative 150,000. I'm going to have my credits be negatives. And then we get to the total property, plant, and equipment, and the total assets. So then I'm going to highlight these. And I'm off here, so what do we have? 1 million, no I'm not, 1,256,000, so we're correct. Okay, so then we're going to keep going. We are on the liabilities, so these are going to be credits, so I'm going to represent it as a negative 205 for accounts payable, and then we have a negative 12 short-term liability, and again if I add those two up, adds up to 212.5. So that's the 212.5 subtotal. And then we've got a long-term liability, 500,000. Not going to put in the subtotal. But if I added up all the liabilities, not including the accumulated depreciation, 712.5, 712.5. So we're on track. Then the long-term, no, actually this one needs to be down here. I'm going to add an account for income tax payable, which we will need at a later time. So then we have the common stock. I'm going to make this blue because this is the capital account, so those are in the middle. So sometimes I like to just show the fact that this is the differing point between the balance sheet and the income statement. So there's the capital, retained earnings 208,788, and no dividends. Now we're at zeros, meaning the debits minus the credits now equal zero, so we are in balance at that time. So then what I'll typically do is then say that we want the ending balance over here. So I'm going to say that ending balance is going to equal the beginning balance plus whatever activity we will put in there. We're going to journalize the activity, basically journalize the budgeting activity. Then I'm just going to highlight this all the way down. I'm going to highlight all the way down to here. And these are all the accounts I'm going to need. So I'm actually going to delete some of these rows. And this is all we're going to need. Delete, shift up. And note that how did these zeros get here? It's just all we did was sum up. We said equals the sum of everything. All this all the way down because we're going to need some income statement accounts. Why does it stop at the balance sheet? Because we're stopping at the point in time at the end of June 30th in this case, and then we're going to budget forward. So we don't have any income statements already closed out to the balance sheet. So I'm going to add some income statement accounts because we're going to need them for the budgeting process. Then if I highlight this across, then we have this. And if you want to know why they're green, I went to the Home tab, Styles, and we went to, when they're equal, I want them to be green. So that means I can see that whether they're green or not, and it'll keep us in balance. So if that equals 0, we're going to have it be green. If it's not 0, then it's going to change, and that'll give us a visual indication. So then I'm going to highlight from A to M, let go, right-click, highlight from A to M, let go, right click, and unhide. Oh, I hid instead of unhide. Let's do that one more time. I'm going to right click and unhide. Alright. Okay, so now notice I've also added just our journal entry area. This is where we're going to enter the journal entries and post them to this section and see what happens. So if we just go through some of our activity, you can say, well, the sales happened and we had sales of this dollar amount. And we know that part of those sales were on account and part of them were for cash. So I'm going to go ahead and post that out. So we're going to have some cash, we're going to have accounts receivable that are going to go up, and the other side of it's going to be sales. Sales is going to be, in the sales, I'm going to have a credit of this number. Now, the problem told us that 70% of our sales are on account. That's what we're budgeting to happen. So I'm going to say the negative, because I want to flip the sign of this number times 0.7, and that'll say this is how much of those sales we're going to have on account. And then the difference between this minus this, which I'm just going to say negative sum, is going to be our plug. That means that much is cash. So now the debits equal the credits, and we can just journalize this transaction and see if it ties out to our ending balance sheet once we're done. We're going to say, okay, cash is here, and accounts receivable is here, and then sales went up down here, like so, and that'll put us back in balance. Now we've recorded our sales, and we can kind of check those off to our ending numbers as we go. And I can kind of say over here, we can say like, well, okay, I've taken a look at this. We've pretty much journalized the activity there. So then what happened is we had the raw material. I'm gonna skip down here to the raw materials. This is what we're gonna produce. And here we have the raw materials that we purchased. And I'm gonna make the assumption first that we purchased it all basically for cash. I'm gonna adjust for that later. But right now, because we bought it on account. But right now, I'm just gonna say we bought it, we're gonna say we bought it all on account. And so these are all the purchases we made, and then we're going to adjust for the fact that we paid for some of it during this 3-month period as well. So if we bought materials all on account, then materials would go up. So I'm going to say raw materials is going to go up with a debit, and then we're going to credit accounts payable here. So I'm going to do this fairly quickly. Accounts payable here, and that's going to equal, I'm just going to say plus or equal to the amount in our raw materials right there. And that's going to be the transaction to record the purchases of our raw materials. Again, we haven't recorded the payment of cash for some of them, but that'll record the purchases. So we got raw materials is going to go up here, and not tax payable, it should be accounts payable. And then accounts payable will be here, and then we'll record that transaction. So now we've kind of recorded basically the activity for the raw materials here, and we'll move on to the finished goods. So next I want to think about basically how much of those raw materials we used and were transferred from raw materials to finished goods. Now note we don't have any work in process here. We're basically saying that we're going to complete them through the process. So in order to do that, we basically have to do the cost of goods manufactured if we really want to check that number. So here's a budgeted cost of goods manufactured. And if we think about the raw materials, we have what we started off, the raw materials that we started off, plus the raw materials that we purchased, less the raw materials at the end. And you can look at the prior video on how we calculated this raw material at the end here. And then if we calculate that out, then this is going to be the direct materials that are going to go from raw materials to finished goods. So I'm going to go ahead and journalize that transaction. That process is going to be finished goods is going to go up with a debit like this. And we're going to reduce raw materials. And the amount is going to, I'm just going to say this equals, I'm going to scroll down to that amount that was in our cost of goods manufactured. Way down here. The cost of goods manufactured, this number right there. Alright, and then that's going to be, of course, the debit and the credit. And if we post this out, then we're going to go to the finished goods here, and that's going to equal this number going up. Going to double click on raw materials because there's something in it, go to the end, and that number is going to go down. So next we're going to record the amount that was recorded for the direct materials. So direct labor here. Now normally this would go into work in process and then we'd process it out to finished goods. But in this case we're going to say that we completed everything. So we're basically saying that all this here, it went through work in process and then it all got completed. So we're just going to basically take it straight to finished goods. This labor is going to go to finished goods. It's going to be part of the inventory. So we're going to say finished goods is going to go up by the labor that was input into it. and we paid that labor. So instead of saying wages expense, we're saying finished goods because that's where the wages are going to. And then cash is going to go down for what we paid our employees. And so that's going to be this here, and we're going to say that equals, and we're going to scroll over to the labor 420. That's the direct labor going into our inventory. In this case, going directly to finished goods because we're going to complete all of the inventory. So finished goods, something's in it. I'm going to double click on it, go to the end of it, say plus, increase it by that 420. Then we're going to go to cash, double click on it, go to the end of it and say plus, and decrease it by that 420. Okay, so next item, let's go ahead and make that green. I'm going to scroll down here and say, okay, that's been input. And we can scroll down and say, now we have the overhead. And remember, there's two pieces of the overhead. One's the variable portion, and then we got the fixed portion. And the fixed portion is accumulated depreciation. So once again, this overhead's going into the inventory. So we know that all of it's going to go into the finished goods because we don't have any work in process. It's all going into finished goods. And then part of it's going to be paid with cash, and the other part of it is going to go into the depreciation, accumulated depreciation. So instead of expensing it, we're not expensing it, we're capitalizing it in the form of the asset. And I'm going to say the cash is going to be a negative of, I'm going to scroll down to the factory overhead of this number, the amount we paid out for the variable overhead portion. And then the accumulated depreciation is going to go up in the credit direction of the 63. And that means that the negative sum of those, the debit then, will be this here. So that's what's going to happen. Our inventory then is going to go up. Once again, finished goods. I'm going to double click on it, go to the end of it. So we've put the raw materials in there, we put the labor in there, and now we're putting the overhead into our inventory. And then cash is going down. So I'm going to double click on that. Cash is going down. And then accumulated depreciation is going up by that 63 right there. All right, so then let's mark that one off. That one is done. So we can scroll down and say, okay, we have that one. And then we got the selling expenses here. So I'm just going to pick all of those up at one. I know they broke them out into two, and we probably should break them out, but we're just trying to check if we're in balance. So I'm just going to say that those are all basically selling and admin. Copy those. They're not part of the inventory. They're not going into the inventory. And that's going to be the equal to this amount down here. Down, down, down to this total. I'm just going to pick up the total for the whole selling and admin right there. And the credit will then be here. And that's going to go to cash. All right, so that one's going to be an actual expense. It's a period cost, and we're going to say that's selling expense and cash up here. Double clicking, going to the end, plus cash is going down. Now cash is negative because we still have to recognize a couple factors on the accrual process. We'll get to that in a second, so don't worry, it'll be all right. Okay, and then we're going to scroll down and say that we have done the selling. Now we're on the general and admin, so general and admin, and we have the salaries here, and then we have the note. So let's take that one by one. We're going to say the general salaries, I just call them gen salaries, just to help us balance this out. It's going to be the debit, it's another period cost of cash, and that's going to equal, and if we scroll over, it's going to equal, scrolling down to the general, it's going to equal that 33 there, and then we're going to credit something, so I'm going to credit the 33 to the cash, and so we've got the general salaries is going to equal that 33, and the cash is going to go down, so I'm going to double click on cash, go to the end of it, that's the credit, and that puts us back in balance here, and then we'll scroll back down, scrolling back down, and highlight that. So we've done this one. Actually, there's one more piece to that. There's the interest. So the interest in the cash. So I'm going to say interest expense on the long-term debt. Interest expense here. Interest expense. And that's going to be the 15 10,000, and we're going to credit cash once again. So cash, and that's going to be interest expense is going to go up in the debit. Cash, we're going to double click on it, go to the end of it, and once again it's negative, but it's going to be okay. We're going to fix that, and cash is going to be credited. All right, now we can highlight that off for sure if we haven't done so far, and we're going to scroll down. So that is in. Okay, so now we're going to account for the cash that we received from the sales that we recorded on account. So we had the cash, but this is the total sales. These are the cash sales, and these are the sales on credit. We recorded that. What we didn't record is the collection of the revenues we made on sales during this time period. So this is the amount we'll need to record. So of the credit sales that we made up here, we have collected some of those. We sold them on credit, but it's been 3 months, so we've collected some of that in this time period. So we're going to debit cash and credit accounts receivable for the amount that we've received on the credit sales that we've made in this quarter. And I'm going to say that equals, and scroll down to the cash. So we're scrolling down to cash down here. Not the budget. We could get it from the budget actually, but it's going to be these items here. So I'm going to go up here and I'm going to sum them up because I don't have a total column on this one. So I'm going to say it's the sum of the collections. So there we have that. And we could then credit the receivable, and now our cash should look a lot better. So we're going to go up to cash, we're going to double click on it, go to the end of it, plus, and then we're going to have our cash here, and our accounts receivable, double click, go to the end of it, plus, and we're going to say the receivables there. Okay, and then we had some miscellaneous items that happened. So that's going to take us through this stuff here. So we basically did the cash here, we did the receivables, so we did that. And then we have the cash budget, and we had some other kind of miscellaneous items. We had this loan interest here. So we've got the, if we want to record that out, we'd have to say that we have interest expense again. Interest expense, and that's for the 120 it was, and we're crediting something and we're going to pay that with cash. Interest expense and cash. So that's the 120. Cash is going down with the credit, and interest expense is going up with the debit. Okay, and if we scroll back down, so we say, okay, we took care of that miscellaneous type item down here. So that's that one. We already recorded this interest, we're okay there. Then we had this equipment. We put the equipment, and we paid cash for equipment. We didn't have finance it or anything. So we're just going to say the equipment on the books. We got more of that. It's going to go up with a debit. And we're going to pay it all with cash. So cash is going to be the 130 on both sides. 130 and 130. So we can record that. It's got to be even. It's got to be a journal entry. It has to work. So we're going to say, all right, go to the end of that. Cash is going to go down with a credit. And we put it into equipment here, plus the debit, like so. And so we've recorded the equipment. That should recognize, we should be okay with our cash there. And then we had the dividend here as well, this dividend. So dividend we paid out with cash, we're saying. So we're going to say, okay, the dividend happened. We're going to pay the owners the dividend. We're going to credit cash for that. So credit cash. And that's going to be 10,000. So there's the dividend, and we're going to record that. Cash is going to go down again by this 10,000. The dividend now is going to be recorded at the 10,000. We did the equipment. Okay, and what else do we have down here? We had this pesky loan that we paid off here, and then we basically took another loan out. So I'm going to net those two out, and note that this should be netted out like this. It should be this minus this. So really what happened is we basically paid off net 3840 to get us to that minimum balance. So instead of writing two journal entries, one paying the loan off and then taking another loan out like we could, I'm just going to say that we paid off over the three month period 3,840 of the loan. So we had a loan at the beginning, 12, and it's down to 8 at 8,160 as of the end. We paid off 3,840 of it. So we're just going to say, I'm just going to say, well, okay, here's my loan amount. It needs to go down with a debit. So we're going to debit that. And then we're going to credit cash. So I'm going to credit cash like that. And the amount's just going to be equal to that number we were just looking at, the 8,000 something, right? Or the 3,840. They're leaving us with 8,000 something, hopefully. And so we're going to say, all right, let's do that. And then if we record this, then the cash is going to go down again. So cash is going to go down. And the short-term note goes from 12 down to that 8,000 something, hopefully. So the short-term note, see here, it goes down to that 81860, which I think is what was left there. Hopefully that's what was left. Okay, so then we're going to go see if there's anything else we need to record in this kind of miscellaneous items. We did all that. Now, the next thing we need to do is record the cost of goods sold. So remember, we did this full calculation here, which allowed us to basically get to the cost of goods manufactured, look at the prior video on how we got to these numbers, and then we used that to get to the cost of goods sold. So the cost of goods sold is going to be a debit to the cost of goods sold and a credit to the finished goods inventory. So, and that's kind of linked to this journal entry up here. Remember, we recorded the sales, and now we're recording the costs of goods sold related to those sales, meaning the inventory, the finished goods we're using. So I'm going to say the finished goods is going to go down. So I'm going to skip a line, put it on the bottom for a credit, and the cost of goods sold, that big expense, is going to be the debit here, and that will be for equal to, and scroll down to the cost of goods sold here, and then we're going to credit the finished goods like so. And if we record that out, then we're going to say cost of goods sold is this debit, and the finished goods up here, finished goods, where did you go? Right there, should be the credit, and there we have that. Now a couple other miscellaneous items we had down here was the on the income statement, we recorded the fact that we are going to owe taxes. So that's going to be a big one, and we said that on the income statement, that's going to be 23,263. So that's why we added that, tax account up here. So we're going to say we didn't pay it yet. We're going to say we have a payable here. So we have a payable, which is going to go up with a credit, and we're going to debit the income tax. So the income tax is going to be the debit, and that will be for, and we'll scroll down to the income statement where we calculated that. It's not affecting cash, but we have this number down here, right there, and there we have that. So I'm going to do that, and we'll scroll up, and we're going to record the income tax. So here's the income tax. Oh, I put the interest into here. This interest should be going up to, so I'm going to cut this, and it should actually be going up here. So I'm going to put it right there. That's where the interest should go. It shouldn't be in the tax line. And then the tax is going to be this 23,263, and we will put it into the tax payable right here. So there's the tax payable. And note, this will keep us in balance. Now it's not green over here because we're off by rounding, and you could fix the conditional formatting to fix that, but we're not going to go into that at this point. Now there's one more kind of major accrual piece that we got to take care of here. I'm going to add another line right there, and that has to do with the fact that we have this payable here. Remember, we increased the payable for what we purchased, and then we paid some of that off. So that one, what's going to happen here is we're going to pay some of that with cash. So I'm going to say the payable is going to go down, and we're going to pay it with cash. So remember, what happens is we buy things on account, and then we pay them off. And the question is, when do we pay them off? This problem happened to say that we buy something and then we pay it off the next month. So for example, if we look up here, we're going to say that this payable, the 205, is something that we're going to pay in the next month. And we're always going to be a month behind, meaning we're going to purchase it on account and then we're going to pay for it a month later. So that means that basically, what are we going to pay off? We're going to pay that equals that 200,005 plus we're going to have to pay off the other purchases here. So raw materials budget, here's our purchases. We paid off July, August, and September is what's still going to be left in ending inventory. So I'm going to add to this amount. We're going to say plus the 20, or we can even point to these, plus this, plus this. And that will leave us with this, hopefully, left in the AP. Let's see if that's the case after we post this out. So I'm going to say this is the debit and the credit here. And we're going to scroll up and go to the accounts payable. Double click, go to the end of it, plus. And we're going to say that's the debit there. And so there we have, and then we're left with that 191625. And then if we go to the cash, we're going to say, okay, let's go to the cash. And that will be decrease in the cash. Brings us to that 40. That looks familiar. So I think that's basically it. Now notice if you do this journal entry by journal entry, then it has to be in balance. You can see exactly which journal entry will throw you out of balance. And now you can go tick and tie off all your numbers. I can say, okay, let's go look at the balance sheet here and see if this ties out to it. So we'll scroll down, balance sheet here, and we'll say, yeah, that works. And then you could basically go line by line and say, all right, I got to scroll way back here. How about 337,680? 337,680, is that tying out to our balance sheet here? It does right there. There's the balance sheet. Then we're looking for that 84,000, which is going to be this 84,000. And then I'm going to go ahead and hide these cells. Hide. And then we're looking for the finished goods, 360. So scroll on down to the balance sheet down here, 360. Then we're looking for the net should be 517 of these two, which is going to be this minus this. So 517 book value on the equipment. So that's going to be the book value on the equipment. This minus this is 517.5. So that's right. I think we already checked it off this. And then you could just go through all of these. And if you're off by any of them, then of course that's where you need to dig down and see if the journal entry is not right. So that's one way you can basically try to figure out something that's off balance, is actually do the journal entries that would be for the predicted or projected time period.